The goal of this series is to help you understand financial markets, not tell you what to buy or sell. Every day, trillions of dollars move through the financial markets. Stocks, bonds, currencies, crypto, and derivatives. But what are you actually buying when you trade them? In the next few minutes, you'll finally understand every major asset class. Let's start with the world's most popular investment, stocks. When you buy a stock, you're not just buying a ticker symbol, you're buying a small ownership stake in a real business. Every share represents a small piece of that company's future. Imagine a company divided into 1 million equal pieces. If you own 10,000 of those shares, you own 1% of the company. As a shareholder, your investment rises or falls with the company's performance, and some shares also carry voting rights. A stock isn't just a number on a screen, it's ownership in a real business. But where does all this buying and selling actually happen? Stock exchanges continually match buyers and sellers through electronic order boxes. Every completed trade helps establish the market price, updated in real time. Every second, millions of participants collectively determine what a share is worth. But what if a company needs money without giving away any ownership? That's where bonds come in. Instead of becoming an owner, you become a lender who earns interest. With bonds, you're lending money, not buying part of the business. Now here's one rule every bond investor should remember. When interest rates rise, existing bonds usually become less valuable. Why? Because new bonds may offer higher interest, making older, lower-paying bonds less attractive. That's why bond prices and interest rates generally move in opposite directions. Now let's move beyond companies and governments to the largest financial market on Earth. It's called the foreign exchange market, or simply Forex. This is where the world's currencies are exchanged every single day. Unlike stocks, currencies are never traded alone. Every Forex trade involves two currency, when you automatically sell the other. If the euro strengthens against the dollar, the euro-USD exchange rate rises. That's why Forex traders always think in pairs, not individual currencies. Unlike stock markets, Forex doesn't rely on a single exchange. As one financial center closes, another opens. When major trading sessions overlap, market often becomes even stronger. That's why the Forex market almost continually from Monday to Friday. Forex prices don't usually move by dollars. They move in tiny units called pips. For many currency pairs, 1 pip is typically the 4th decimal place of the exchange rate. Small price changes can add up quickly, which is why Forex traders pay close attention to every pip. Because currency prices often move by tiny amounts, many Forex traders use leverage. Leverage increases your market exposure without changing the market itself. But remember, the same leverage gains can also magnify losses. Leverage is a powerful tool, but it demands disciplined risk management. Let's quickly bring everything together. Stocks give you ownership, bonds let you lend money, and Forex is the exchange of global currencies. Together, they form the foundation of the global financial system. Now, let's step into the newest frontier of finance. Now let's enter one of the newest asset classes in modern finance. Unlike traditional currencies, cryptocurrencies operate on decentralized blockchain networks. Instead of relying on one central authority, the network is maintained by many independent computers. That's what makes cryptocurrency fundamentally different from traditional money. Bitcoin was designed with a limited maximum supply of 21 million coins. Ethereum goes beyond digital money by supporting price amortizations. Bitcoin is often viewed as a digital store of value, while Ethereum a platform for programmable blockchain blockchains. Together, they have played a major role in shaping cryptocurrency ecosystem. Crypto markets can move incredibly fast. Large gains can be followed by equally sharp declines in a very short time. Market sentiment, liquidity, and global events can all contribute to rapid price changes. Higher potential returns often come with higher risk and greater volatility. Now we arrive at one of the most advanced areas of finance. These contracts don't represent ownership of the asset itself. Instead, their value changes because the underlying asset changes. That's why they're called derivatives. Their value is derived from something else. A derivative always depends on something else for its value. That underlying asset could be a stock, a commodity, a cryptocurrency, or even an entire market index. When the underlying asset moves, the derivative moves with it. Understanding the underlying asset is the first step to understanding any derivative. Now you've seen the 5 major asset classes that power today's financial markets. Each one plays a different role, and each comes with its own opportunities and risks. But here's what professional traders understand, and how just to use move billion one between these markets. Watch the next lesson and subscribe to continue your journey. The best investment you'll ever make is in your own knowledge. Always do your own research before investing. This series is for educational purposes only, not financial or investment advice. I'll see you in the next lesson.